I wanted to make sure to introduce the next panel, which is all about profits. We're in this brave new world of profits. Less so on the AI side, it's mostly just revenue. But I think what's important is for the conversations at Techtalia to cover all realms of the startup ecosystem globally, but also private equity too. So I'd like to introduce the moderator for the next panel, Pietro Caliceti from Greenberg Traurig, who's actually sponsoring this panel. Sorry, we have Pietro over here, right? And then we have Luke Alvarez, Matteo Siani from Three Hills, and we have Benjamin Charbit, my very good friend Ben. Are we missing anybody else? Who else are we missing? Tommaso Dragani from the Venom. And I wanted to make sure that we have the largest panel that we've had at Techtalia as well for this year.
Thank you, Gabriel. Thank you, everyone in here, for taking the time to be here. And thanks to my panel, I'm honored to be moderating such a panel with such a nice participation of successful entrepreneurs and managers. Brave New World, it's a Huxley quotation, I think. And it's quite strange, actually, that we need to talk about profits, because that would be a normal thing to give as an assumption if we talk about business. But this is not actually the case. It's not always been the case. If we look at what happened in the VC environment in at least starting from 2020 and for some years thereafter, profit was not a key element in the decision and the allocation of investments. This was a combination of factors. Interest rates were low. There was plenty of capital available to GPs. And the result of that was that almost anything that had a nice narrative was sold. And this led to an enormous number of deals and numbers of investments and an unproportionate number of unicorns. But as we see now, not all that glittered at that time was gold. And now we are in a situation where apparently things are still running smooth. If we look at the data in Q1 2025, we see that the investments in VC capital have reached a 10-quarter high with 126 billion invested. And we also have the second highest number of unicorns per quarter, 35 unicorns in Q1 2025. But that's just the surface of the story. If we set aside AI, and we'll touch back on that later on, but if we look at the numbers depurated from AI, the reality is much more crude. And in fact, in number of deals, VC, the venture capital business has decreased by 15% compared to the previous year. And in number of fundraising, the decrease is even more worrying. It's a minus 25% compared to 2024. Why? Well, mostly because of what I mentioned at the beginning. I mean, a number of investments were made on valuations which have turned out to be just too high. And add to that the uncertainty that we are all experiencing these days, both in terms of geopolitical situation, in terms of tariffs, possibly also in terms of interest rates, even though in the latest months. This may be the factor that has enhanced more of the three that I mentioned. Now, the attention now, as the title of this panel suggests, is profit. So in these days, it's not sufficient to have a nice narrative to become a target. You also have to show that you're able or will be able to deliver profits in a short time. Now, from my perspective, this raises at least two questions initially, which I would like to know Luke's comment on. And the first question is, to what extent, if any, does this attention to profit deviate the VC word from what it was intended to be? I mean, it's the attention and the worry for profits, as I see it, was something that was more. It's structurally something more related to other kind of investors like PE or other sort of investment firms. So my first question is this the sign of a decrease of interest in the VC industry per se? And the second question is also related to the what we can see in terms of the fundraising difficulties that I mentioned before, because if we look at who has raised capital these days, you see that there's a clear shift, and the funds that have suffered the most are the smallest funds and the funds that have the less experience. So funds that have managers that have 3 or less than funds on their track record. So is this are these developments in the industry also leading to a reshaping of the scenario of the players in this industry? Are we supposed to expect a scenario where only few or fewer funds will remain and bigger than that? And to what extent also this change, if any, changes the physiognomy of the industry, which was typically, aimed also or with a space also for funds that were not so big as in other kinds of investment firms. Thanks.
Totally. Well, I mean, there's a lot in that. I think at a high level, if you look at the numbers, venture capital offers the best returns of any asset class. But it's all, and you compare it to sort of hedge funds, private equity, corporate debt, etc. The challenge is it is also the most dispersed. You get the widest dispersion. So the top 10% of funds are an extraordinary investment. The bottom 50% of funds are a terrible investment, right? And that's not true if you're investing in bonds or in the stock market. So you got to pick really good funds. What happened sort of 2018 through to 2022 with all that cheap money was we got an explosion in the number of venture funds. You're absolutely right, there's a winnowing out now because a lot of the funds and other strategies, sort of crypto funds and so on and so forth, that were deploying capital through that hypey period, put money into rubbish businesses or put money into great businesses but at crazy valuations, right? And either of those things is a mistake. What we're now seeing is the performance of those funds come through, where there was enough time has passed to see whether or not there are good companies and whether those companies are growing and ultimately making money. And a lot of the funds are getting filtered out. And we've got a couple of funds under our belt. I'm glad to say both of them doing really well. We've had exits, trade sales, and we've actually got one studio at the moment that's doing north of 100 million, 50 million of EBIT annually, actually paying dividends, which is not meant to happen in venture capital. So we have actually distributed a dividend, not very tax efficient way of getting money to LPs. But certainly if you invested in dumb shit or at crazy valuations, you're not going to raise another fund. We're in the happy position of launching now a much bigger fund on the back of our performance in the first couple of funds. But I mean, venture capital is sexy and people get excited about the big vision and the big narrative, but ultimately it's an asset management game and you've got to deliver performance, and that means investing in good stuff at sensible valuations and then selling it to somebody, right? Profits may or may not matter in that. You know, I think what we're seeing with AI, which is some 70% plus of that huge amount of capital that is currently being deployed, is, you know, some of the fastest growing companies by user numbers, in fact, the fastest growing companies by user numbers and by revenue progression. You know, OpenAI launched ChatGPT 3 years ago. They're going to do circa, I think, 15 billion or so revenue this year. They're all, you know, almost at 1 billion users, much, much faster than Facebook or Google or whatever. And a lot of other, I mean, there's a European company, Lovable, doing 100 million. It's like 2 years old. So there's some extraordinary companies growing incredibly quickly. People are quite happy to fund losses when there's that rate of growth. If you're a 10-year-old company that's still losing money, you're probably going to struggle to raise right now.
Thanks. And touching on the AI, Ben, what is your view on this? I mean, what is, doesn't this risk to be another sort of bubble in a way? What are the elements that one should look at, most importantly, with respect to investments in AI?
I think it's already obviously a bubble, but it doesn't mean that all investment in AI are bad and wrong. The challenge that I've seen, and I've been lucky because I managed to invest in one of the good companies, but it was a very big mind stretch, I think, as an angel investor, to understand, you know, the economics of entering in such high valuation like project with this type of valuations. You know, where traditionally you always try to enter early, we're at a low price, so you'll get, of course, you'll maximize your chance of having a good return. But with AI, of course, it never happens. You know, you immediately enter in pre-seeds or seed rounds that already reach insane valuation. I think I read today that the last round of OpenAI is at $500 billion. So we're obviously dealing with economics that are very, very different. And so it probably calls for, you know, a different kind of investors who are probably applying different type of frameworks. So I think it reshapes in a way. AI, I think, is a complete different category. It's pretty obvious, but it really is every day proving that, you know, you can't apply the same type of methodologies as you have done in the past for another class of another type of business.
Thanks. And Tommaso, we've touched on the fundraising struggles. This also affects the stage of the company that VC are investing in, and especially in Italy, because in Italy, unfortunately, we still lack, to some extent, the kind of funds that can invest or want to invest in a sort of seed or even pre-seed environment, which is something that you have experienced as a founder.
Yes,
can you touch on that?
I founded Aspidia. It's a biotech company working on new bioremediation methods for PFAS. They are toxic pollutants present in the waters. And I was looking for funds, for pre-seed funds in Italy. And it's very difficult. I experienced a lot of difficulties. Indeed, not because of the project, since I talked with several funds, and all they said, wow, that's a great project. We are willing to fund it. But however, we will not be the first one. So we are not willing to be the first one to fund these projects. So we are facing in a difficult situation where it's very difficult to find the first one to found an interesting project. Whereas maybe a characteristic of Italy, since in other countries, let's say in Switzerland, I found some competing startups that succeeded in pre-seeds funds, that they succeeded in getting millions of Swiss francs for really very small projects on related fields as my field.
I'm sure you will find one as well, and your company truly deserves. Now, I know we're running short of time, but I would like to end with a question to Matteo, which I'm particularly interested in, because I'm glad that Matteo is here, because he offers a different perspective, because he's a partner, an operating partner of a firm that works primarily with private equity and private capital, most precisely. And I would like to come back to one of my initial remarks, being that possibly this new attention and focus on profits may shift the balance from VC to other kind of investors, and most importantly, private equity. Now, as I see it from my perspective as a lawyer, VCs versus PE have some pros and cons, being in terms of cons, that the VC are traditionally have less ability or willingness to influence the management of the company they invest in. And second, that the management of the targets of VC tend to be more inexperienced in finance and profit-related matters. And third, maybe this is not always the case, but sometimes, it's also possible that VC are less able to influence management due to the cap table of a company they invest in, because sometimes the cap table of startups, at least in Italy, you find situations with such a number of investors that it's actually difficult for anyone to have a real voice in it. But on the other side, VCs have significant pros as opposed to PE. First of all, being that they base their business on a sort of Pareto bet or wager. So out of 5 investments, they are satisfied if just one of that is successful, which is not always the case. It's not actually the case for PE. They normally also have less time constraint than traditional investors, and also, and most importantly, the deal structures and the company structures of their targets is much more adaptable or apt to deliver interesting profits for investors, as opposed to the normal targets of PE. And I'm thinking about what you usually find in a SAFE instrument in terms of liquidation preference, etc., all that instruments that you not so easily or never find in a target of a PE. What's your view on that, Matteo?
Thanks, Pietro. Let me first make a step back. Why profits are relevant also for PE? You would say profits have always been relevant for a PE firm. We are mid-sized PE firm, so we normally, of course, invest in companies which are already cash generative, positive EBITDA. But what we're seeing in the market at the moment is a general risk aversion. So it's difficult to raise capital, it's difficult to deploy capital, it's difficult to exit investments in general. And this is, we believe it's in part related to the big or increasing uncertainties in the market. We have several important markets affected by wars, Russia, but you know very well. You have the US market, which is becoming more risky. Tariffs are changing every other week. So it's difficult to think of, making investments. So, one of the leading economy becoming apparently risky is, of course, affecting also the the risk aversion of investment. So there is a shift towards less riskier assets and towards quality of assets. So for example, we see a lot of demand of private credit instruments or strategies, less of equity, for example. That shows the interest of LPs is shifting towards less risky strategies. So when you think about investing in equity, of course there is much more attention on profits and quality of the assets. If there were industries, I mean, not only tech, but if you think fashion, for example, that were valuing businesses based on growth potential, sales, clients, order books, because there was the idea that no matter what the profit is, in some high growth industries, the most important thing was scaling the business, then profit one way or another that will come. The situation in the market showed us that this is not true. A lot of businesses grew significantly, but they never delivered profits. They never delivered cash flows. So there is what we perceive, there is a shift towards different metrics. I mean, we mentioned AI, which probably is the only area where valuations are still more based on growth potentials and opportunities. But in many other industries where in the past growth and potential for growth was a base of valuation, now are switching their attention more to ability to deliver profit, to deliver EBITDA, to generate cash flow. So yeah, that of course requires operators to do a different job. And so in part, we are asked to be more active in our assets. So we're a lot of private equity funds mainly it started more first in the US, now also in mid-sized funds in Europe, for example, are investing in value creation teams, for example, because there is a need for investors, for GP, to be much more active and to drive profitability within the company. It's not enough to find the right asset, to do some buy and build strategy, and then you're going to sell it at a good returns. Now you need to deliver quality, you need to deliver profits, you need to work on profitability. This is probably, again, going back to my initial remark, it's probably due to the uncertainty of the market and the risk aversion, but this is definitely a trend that we see very strong in the market. And I don't know how much this can apply to VC, but I see in general is a trend that affects all investors. So I assume that it should apply to VC as well.
Are super proactive with their portfolios as well. Famous story of, I think it was Sequoia back in the early days when they backed Atari, beginning of the games explosion in the 1970s, the early consoles. And Nolan Bushnell, who was the founder CEO, this incredible visionary, wanted to do his first board meeting in a hot tub smoking weed. And the VC got into the hot tub and kind of did the deal. But very quickly brought in really professional COO to work alongside Nolan to help them scale the business. They did the same thing with the Google founders, bringing in Eric Schmidt. We've done the same thing across our portfolio. Private equity, if you don't like the CEO, you can fire him. VC, we usually don't have the rights that enables us to do that, but it doesn't mean we don't bring in people and work with management closely to help them grow.
Yeah, thanks. This was a very interesting point, and I think if we want to sum up what the outcome of the debate is that, yes, the VC, I think, still has a very important role to play, but VC in the future will need to pay attention also to management, to actually drive the company, not just limiting themselves to have an observer on the board. Will need to be more active, and the market will only be for funds that will be able to take that attitude and sustain it. Yeah, I think that's the pick from our talk. And thank you everyone for your contribution. and thank you for attending.